years ago, around this time, I created a video on top small cap superstars, and one of the stock in that list was Happiest Mind. Later, I even discussed the fundamentals of Happiest Mind in detail. During that time, Happiest Mind was one of the hot favorite stock among investors. It was because company launched its IPO in September 2020 during COVID, and that time shares of digital and tech companies were in huge demand. And when Happiest Mind launched its IPO, everyone wanted to grab a pie from it. As a result, Happiest Mind share zoomed 9 times within 10 months of launch of its IPO. However, it's been 20 months, Happiest Mind is down 42% from its peak, and investors of Happiest Mind are totally confused. Should you accumulate it, hold it, or simply sell it? Hey everyone, my name is Sahil and this is my Personal Finance Academy. When Happiest Mind launched its IPO in September 2020, the IPO price was set at 166 rupee, valuing the company at market cap of around 2,500 crore. But within 10 months of IPO, Happiest Mind touched a peak of 1,500 rupee, which was 9 times jump from its IPO price, taking its market cap to 22,000 crore rupees. It was one of the sharpest jump in the share price history. Now there were 3 major reasons for this crazy jump. First was IT boom. COVID resulted in lockdowns and everyone shifted online. That resulted in sharp jump in quarter-on-quarter earnings of digital companies. Naturally, it created high demand for IT and tech shares. Second, crazy liquidity post-COVID. To save the economy from COVID disaster, government pumped billions of dollars and reduced the interest rates. Especially in US, the interest rates were at near zero level that resulted in availability of cheap money. Hence, a huge amount of money got pumped into Indian economy via FII route. Due to that, Indian markets started going up and that attracted a lot of retail investors. In short, it was a crazy bull market. People were even borrowing money to invest in stock market. This bull period also attracted a lot of new investors who had no clue about stock picking. Hence, due to crazy liquidity and of course the IT boom, the share price of digital companies zoomed exponentially. And third reason was strong fundamentals of Happiest Mind. When everyone was investing in IT and digital sector, Happiest Mind that launched its IPO during 2020 of September attracted the eyeballs of many investors. The biggest USP of Happiest Mind was captured in its tagline that says, "Born Digital, Born Agile." So basically, Happiest Mind positioned itself as a new age IT company that focuses mainly on latest technologies that are in high demand. In fact, during IPO, company mentioned that in FY20, 96.6% revenue were from digital services that were expected to grow at a very fast rate in IT sector. On top of that, Happiest Mind had a very strong promoter pedigree of Mr. Ashok Soota, who has decades of experience in IT sector and served as vice chairman of Wipro. Then later he established Mindtree, which again became a very successful company. Ashok Soota has a great track record in IT industry. And another reason was market cap. During IPO, Happiest Mind was a very small cap company with a market cap of just 2,500 crore. So everyone expected that Happiest Mind can be the next TCS or Infosys that can become one of the biggest wealth creator. Naturally, it created crazy demand for Happiest Mind shares. Mind you, it was also the period of crazy liquidity with very cheap money in the market. So all these factors resulted in Happiest Mind IPO getting stellar response and it was oversubscribed 151 times. So for every one share, there were 151 requests. As a result, on day 1, Happiest Mind opened at 351 rupee, generating 111% return to those who subscribed and got the allotment. The share price did not stop at 351. Post IPO, Happiest Mind started posting its quarterly results and the results were exceptional. For instance, in FY 2019, Happiest Mind total profit was 14 crore. In FY 20, profit zoomed to 73 crore. In FY 21, profit zoomed to 162 crore. So quarter on quarter, company was posting stellar numbers. Hence, its share price kept on rising and within 10 months, Happiest Mind share touched a peak of 1,500 rupee. While everyone still believed in Happiest Mind future potential, this crazy jump of 9 times in 10 months made Happiest Mind super expensive. At its peak, company was trading at a PE ratio of 144. Basically, the 9 times growth in share price that should have happened over a period of say 5 to 6 years happened within 10 months. But when economy started opening up in US, inflation started kicking in. Hence, US Fed started rising interest rates and eventually FIs started pulling out money from Indian market. And then liquidity in the market started drying out and cost of money started increasing. Since Existing investors of Happiest Minds generated humongous returns in a short span. They started profit booking. Moreover, when economy started opening up, Happiest Minds margins that zoomed from 9% to 14% to 25% slightly got reduced to 24% in FY22. As a result, its net profit in FY22 was 181 crore. Since Happiest Minds was commanding a very high premium, this stagnation in earning resulted in further profit booking, and it's been 20 months, Happiest Minds is down 42% from its peak. Now, obviously, various investors entered into this stock at different levels. Some might have entered at an early stage and would still be sitting on good profits, while those who have invested near the peak price would be sitting on heavy losses. So first of all, let me clarify that fundamentally there is no problem with Happiest Minds. Company is fundamentally super strong and it is still one of the top small cap stocks. The only challenge is valuation. In spite of 42% correction from its peak, Happiest Minds is still trading at a P ratio of 57. The question here is, are these valuations still expensive? Can Happiest Minds again touch the high of 1500? If yes, then when? Let's try to find out the answers. So currently Happiest Minds is trading at levels of around 870, which is 42% below its peak of 1500 rupee. At current levels, the P ratio is 57. Now, how do you know if this P ratio is expensive or cheap or fairly priced? So there is no fixed formula. One of the ways to look at the valuation is peer comparison. Now here, you can't just compare Happiest Minds PE with the PE ratio of large cap IT companies like TCS, Infosys, HCL, etc. Because large cap IT companies are already in matured state and hence they won't command very high PE. Compared to that, Happiest Minds is still a small cap company with potential to grow at much faster rate. And B, traditional IT companies still have a big portion of revenue coming from legacy businesses, whereas in Happiest Minds, 97% revenue comes from new age digital companies. So you can't say that since TCS Infosys commands a PE ratio in the range of 25-30, Happiest Minds PE at 57 is expensive. No, that would be wrong. The right way to look at the valuation is to gauge the future earning potential. If Happiest Minds can continue to grow at 25% CAGR rate in the next 5 to 10 years, then current valuations are justified. So I tried to understand Happiest Minds near-term and long-term growth prospect in their latest analyst con call. So first major update is on growth front. Management has mentioned that they are on track to achieve a 25% growth in FY23 as per what they have guided before. And their EBITDA margins are also at 26%, which are even higher than their guidance of around 22 to 24% and one of the industry leading margins. Their profitability is also very high with latest ROE at 29.4%, ROCE at 34.9%. So company is on track to achieve what they have guided for FY23. Also, their attrition rate for Q3 now stood at 20.9% against 23.5% last year. So fall in attrition is also a positive sign from supply perspective. Company is also growing in terms of new businesses and new deal wins. Company added 9 new clients in Q3 and their total client base now stood at 230. Interestingly, 50% of their revenue comes from clients with whom they have more than 5 years of relationship with 92% repeat business. So that shows the customer stickiness, which is very important for growth. Company is adding new capabilities and building new digital solutions around technology like analytics, artificial intelligence, computer vision, natural language processing, and machine learning. And these investments would continue to reap rewards in the future. Moreover, company is now investing in building platforms that would generate recurring revenue and would help them in scaling their business across clients, sectors, and geography. Another important highlight from the con call was that Happiest Minds is now planning to strengthen its presence in BFSI and healthcare domain. So BFSI stands for Banking and Financial Services. Mind you, BFSI is the largest revenue contributor in IT industry. Currently, Happiest Minds major revenue comes from EdTech domain that contributes 23%, then high-tech contribution is around 15%, followed with retail. BFSI contribution is only 10%. So there is a good potential to grow in BFSI segment, and healthcare is also a fast-growing sector. Just to help you with revenue breakup in terms of technology, 45% revenue comes from digital infra and cloud, 20% from SaaS, 13% from security, 12% from analytics, 5% from IoT, and so on. And in terms of geography, America contributes the most with 67%, followed with India and then Europe. Now, if you look at the vision for Happiest Minds, Mr. Ashok Soota, who is the founder and chairman of the company, has set up a target of generating $1 billion revenue by 2031. That's roughly around 8,000 crore rupees. Currently, company revenue in last 12 months stood at 1,350 crore. So in order to achieve their vision, company needs to grow at 25% CAGR rate. And Ashok Sutta has mentioned that they are targeting to grow at 25% CAGR over the next 5 years. So if Happiest Mind can achieve its guidance of 25% CAGR growth, the current valuations are justified. It's neither too high nor too low. In fact, if there is any correction in the share price, it will make the share even more attractive. So from here, if we assume a 25% CAGR growth and expect the similar growth in share price, it will take another 2 to 3 years for Happiest Mind to reach its previous high of 1500 rupee. Like I said before, the business is solid, management is top notch, company is growing at good rate. Only issue is that company share price jumped too much post its IPO. Having said this, if you keep patience and stay invested, Happiest Mind will surely cross its previous high of 1500 rupee. After 42% correction in last 20 months and considering the growth prospect in the future, current valuations are looking fair. Mind you, even at current levels, Happiest Mind has generated 5 times return in less than 3 years since IPO. But another 10-15% correction will make the valuation even more attractive and would create a good buying opportunity. Alternately, if the share price remains in similar range in the next 6 months and the earnings grow, it will result in fall in PE ratio. So a PE ratio of around 40-45 would make the valuation more attractive and would create buying opportunity. For now, I am holding my investment in Happiest Mind. I hope this video will give you a good picture in terms of what you can expect from Happiest Mind. Now tell me whether you are adding, holding or selling Happiest Mind. If you find this video useful, do like and share it. And to stay updated with more informative content on investment and personal finance, all you need to do is click on that subscribe button and press the bell icon. I'll see you next video. Till then, take care.